the Federal Reserve, a mysterious force behind the scenes. It shapes the economy, guides the markets, and controls the flow of money. But behind its towering influence lies a deeper, darker truth. What is the true nature of the Fed's power? And what does it mean for you, the everyday citizen? Let's uncover the reality. In 1913, the Federal Reserve was born in the shadows of a financial crisis. It promised stability. It promised control, a single institution to guide the country's monetary flow. But what was the price of that promise? A monopoly, a power centralized in the hands of a few. At first, it was a necessary tool. The U.S. economy had been crippled by panic and collapse. But the Federal Reserve didn't just restore balance, it reshaped the very foundation of American finance. Before the Fed, the economy was a wild beast, unpredictable and volatile. Bank runs, panics. The country lived in a constant state of fear. Then along came the Federal Reserve. It emerged as a savior, a central authority to stabilize the storm. The U.S. would never face another collapse under its watch. Or so they said. The truth? The Federal Reserve took control of the very lifeblood of the economy, money. The power to create it, control it, regulate it. In the process, the Fed established a monopoly, one institution that could dictate the flow of money, credit, and ultimately the destiny of the nation. This monopoly wasn't just economic. It was political. A private entity granted public trust. In return, the American people allowed it to make decisions in their name, often without them knowing. Public trust, private control, a marriage forged in secrecy, yet played out in the open. The question lingers. How much control should one institution have? The Fed's origins are shrouded in history, but the implications stretch far beyond its formation. Sound familiar? We'll come back to this. Leverage. The art of borrowing power. It's the tool that the Federal Reserve wields to shape the economy. But it's not the kind of power you can see. It's the kind that works beneath the surface, pulling strings that control everything above. The Fed doesn't create wealth. It creates leverage. Every dollar it issues is backed by borrowed trust, not tangible value. It is debt masquerading as prosperity. Every new loan, every new bond issued is another thread in a web of financial illusion. This is where the Fed's true power lies. It uses leverage to amplify its influence on the markets, on interest rates, on the very money you hold in your wallet. The Federal Reserve's control over interest rates alone determines how easy or hard it is for banks to lend money, which in turn shapes the flow of credit and capital throughout the economy. But here's the catch. This isn't real wealth. It's the illusion of it. A dollar doesn't become more valuable just because the Fed issues more of them. In fact, the more they create, the less each dollar is worth. This is inflation, debt disguised as growth, prosperity bought on credit. The economy doesn't grow from these actions. It just looks like it's growing. A balloon inflated by endless borrowing. But at some point, that balloon will burst. It's a game of leverage, and the stakes couldn't be higher. The Fed borrows today to pay for tomorrow's promises. But who will pay when those promises come due? Debt doesn't create wealth. It builds the illusion of stability. Keep watching. The Federal Reserve claims to bring stability, a stabilizing force in a world of uncertainty. It promises to control inflation, smooth out the ups and downs, keep the economy humming along. But what if that stability is nothing more than a facade? What if, in its pursuit of balance, it only deepens the divide between those who have and those who have nothing? Take a closer look. While financial markets surge, the real story is different. The rich get richer and the poor are left behind. The Fed's actions, designed to stabilize the economy, are the very forces that concentrate wealth in the hands of a few. Low interest rates, easy credit, stimulus packages. They inflate asset prices, stocks, bonds, real estate. But who owns these assets? Not the average worker. It's the top 1% who see their wealth skyrocket. Meanwhile, wages remain stagnant. Inflation erodes the purchasing power of the common worker. The cost of living rises, but income barely keeps pace. The wealth gap widens, and the middle class is squeezed. The Fed's tools have one purpose: to maintain the illusion of prosperity. The financial system looks stable, but in reality, it's only stable for those already at the top. The Fed has become the architect of a two-tiered system, where the wealthy continue to profit and everyone else watches from the sidelines. In 2008, the economy collapsed, a sudden, catastrophic crash that wiped out trillions in wealth and left millions in ruin. The shockwaves were felt across the globe. But was it just a random event, a market failure? Or was it the inevitable result of years of excessive leverage? The answer is far simpler and darker than we've been led to believe. The Federal Reserve, through its policies of low interest rates and easy credit, played a direct role in fueling the housing bubble that burst in 2008. For years, the Fed pushed a system of low-cost loans, encouraging home buyers and financial institutions to take on more debt. The result? A real estate market inflated beyond its true value. Banks, motivated by the promise of quick profits, bundled risky mortgages into securities, selling them to investors who believed they were safe. But when home prices fell and people began defaulting on their loans, the entire financial system unraveled. The Fed had created a house of cards, and when one piece fell, everything collapsed. This wasn't just a housing crisis, it was a systemic one. A system built on fragility, where debt was layered upon debt, and regulation was lax or non-existent. The very policies that were supposed to protect the economy only served to expose its weakness. The crisis didn't solve the problem. It only exposed it. What has really changed? Let's find out. The tools have changed. The methods, though, remain the same. Today, financial systems operate with digital precision. Apps, algorithms, high-frequency trading. The speed and scale of modern markets have evolved, but the Fed's influence has adapted right alongside them. It's more hidden now, embedded within the vast networks of financial technology. But make no mistake, its power has only grown stronger. While the face of the financial world has transformed, the fundamental dynamics of control haven't. The Fed's ability to influence money, credit, and markets remains unchallenged. In fact, it's more insidious now. Where once the Fed's decisions could be seen in the interest rate changes or open market operations, today its reach is felt through the algorithms running in the background. Every market shift, every ripple, is amplified by the digital tools now at play. These digital systems, built on speed and connectivity, are as much a reflection of the Fed's foundational influence as they are a symptom of its legacy. Apps are used to create wealth. High-frequency trading bots move billions in milliseconds, but underneath it all, the same pattern exists. The rich get richer, and the instability we witnessed in 2008 is just a whisper away. The illusion of growth is stronger than ever. The systems are interconnected now, faster, more complex, more fragile. One shock in the system, one algorithmic hiccup, and the whole structure could come crashing down. It won't take much. We've seen this before, and the tech-driven world is no more immune to collapse than the one the Fed first built. The Fed's grip on the digital age is as powerful as ever. But is this system more resilient or more fragile? We'll find out soon. The Federal Reserve's influence is no longer confined to the United States. Its policies ripple across borders, touching every corner of the globe. What begins as a move in Washington, D.C. is felt in Tokyo, London, and Rio de Janeiro. The Fed's reach is now global, and so are the consequences. The global financial system has become interconnected, each nation's economy tethered to the policies of one central bank. When the Fed tightens or loosens its grip on credit, the world feels it. When it raises interest rates, developing countries with dollar-denominated debt can face immediate hardship. The dollar is the world's reserve currency. And as goes the dollar, so goes the world. This is the cycle of trust. We trust the system, trust that it will deliver stability and growth. But time and time again, that trust is broken. The system falters, and we rebuild. We tell ourselves it will be different next time. We put our faith in the same system, only to watch it crumble again. Every time the system breaks, trust erodes a little more. The cycle becomes more fragile. Trust, once lost, is hard to regain. The system, meant to protect us, becomes the very thing that threatens us. And the more we rely on it, the more vulnerable we become. Will this cycle ever end, or are we doomed to repeat it? Can we break free from the chains of an unstable financial system, or is it already too late? The answers lie ahead, if we choose to look. The Federal Reserve's influence on the global economy has shaped the world as we know it, both its strengths and its cracks. What started as a tool for stability has become a system that breeds inequality, fosters fragility, and perpetuates cycles of boom and bust. It is a system built on leverage, trust, and ultimately illusion. But the question remains, is it possible to break free from this cycle, or are we trapped in a financial system too big to fail, but too unstable to thrive? Like this video, subscribe to this channel, comment down below with your thoughts.